Hey everyone, and welcome! If you're prepping for your CA Enter exams, you already know Amalgamation of Companies is one of those beastly chapters. Well, today we're going to do a full, rapid-fire revision of every single thing you need to know to absolutely crush it. So let's just dive right in, shall we? But hold on, before we start, let me throw this at you. Picture it. You're in the exam hall. You see that a purchasing company is paying off the debenture holders of the company it's buying. So you dutifully add that payment into your purchase consideration calculation, and you've just walked right into one of ICAI's classic traps. We're going to come back to exactly why in just a few minutes, so keep that question simmering in the back of your mind. Okay, let's kick things off with Section 1, the basics. Look, before we jump into any heavy-duty accounting, we've got to make sure we're all on the same page with the lingo. This stuff is fundamental. This little table breaks down the three main scenarios you're going to see. First up, amalgamation. Just think A plus B equals C. Two existing companies get liquidated to form one brand new company. Then you've got absorption. This is more like A plus B equals A. A big existing company basically swallows up a smaller one. And finally, external reconstruction. Think of this as Company A becoming Company B. An old, maybe struggling company is wound up, and a new one is formed to take over its business. Now, here's the crucial exam tip. Even though these are different business situations, the accounting treatment under AS 14 is pretty much the same for all three. All right, on to Section 2. Now pay close attention, because this is probably the single most important decision you'll make in the entire chapter. Is this thing a merger, or is it a purchase? I'm not kidding. If you get this right, you're golden. But if you get it wrong, pretty much every journal entry you make from this point on is going to be incorrect. For any amalgamation to be called a merger, AS 14 has this non-negotiable checklist of 5 conditions. And listen up, because this is key. All 5 must be ticked. Not 4, not 3, all of them. This is a favorite theory question for ICAI. In a nutshell, all assets and liabilities have to move over. At least 90% of the old shareholders have to become new shareholders. The payment has to be in equity shares, the business has to continue, and everything is recorded at book value. If even one of these fails, poof, it's not a merger. It defaults to being a purchase. And this slide right here shows you why that distinction matters so much. In a merger, you use something called the pooling of interest method. You take assets at book value and, this is huge, you carry forward all the reserves of the old company. Any difference between the price you paid and the share capital you took on just gets adjusted against your own reserves. But in a purchase, it's a whole different ballgame. You use the purchase method. Assets come in at their fair value, you only bring over statutory reserves, and the difference between what you paid and the net assets you got creates either goodwill or a capital reserve. The impact on the balance sheet is massive. All right, Section 3. Time to get our hands dirty with some numbers. Calculating the purchase consideration, or PC as we'll call it, is the first real practical step in nearly every single exam problem. And if you mess this up, the rest of your solution is basically built on a shaky foundation. So let's circle back to that question I asked at the very beginning. AS 14 is super specific. It defines purchase consideration as whatever is paid to the shareholders only. That means both equity and preference shareholders. And there it is, the exam trap in black and white. Any payment made to debenture holders or any other creditors is not, I'm going to say it again, not part of the purchase consideration. That's just the new company settling a liability it took over. If you include that in your PC calculation, you are absolutely guaranteed to lose marks. Now, there are 4 main ways the exam question might ask you to calculate this PC. Lump sum is the easiest. It's just a single fixed number. The net payment method is the one you'll see most often. You just add up every single thing given to the shareholders. Then there's the net assets method, where you figure out the value of the assets you got minus the liabilities you took on. And finally, the intrinsic value method, which is all about figuring out a fair share exchange ratio. Let's see how they work. Okay, check out this classic net payments example. First, we figure out what we're giving the preference shareholders. They get new shares worth $1,50,000. Simple enough. Next up, the equity shareholders. They're getting 2 things, some cash, which is $1 lakh, and new equity shares. Now notice we value those new shares at their market price of $125, not their face value, which gives us $7,50,000. So the total PC? You just add it all up, $1,50,000 for the preference guys, plus $1 lakh in cash, and $7,50,000 in shares for the equity guys. And boom, our final PC is 10 lakhs. Now let's look at the net assets method. You'll often use this when the question doesn't spell out the payments to shareholders. The logic here is simple. The price is just the value of the net stuff you're getting. So you take the total agreed value of all the assets being taken over, in this case, 46,25,000. Then, from that, you subtract the total agreed value of all the liabilities being taken over, which is 12,70,000. The purchase consideration is just the difference, assets minus liabilities, giving us a final figure of 33,55,000. And finally, we have the intrinsic value method. This one's all about finding a fair share swap ratio. So let's say the selling company's share is worth 20 and the buying company's share is worth 30. That means the exchange ratio is 20 over 30. We use that ratio to figure out the value of the new equity shares we need to issue, which comes out to 5,000 here. We add that to the 3,000 being paid to the preference shareholders and we get our total PC of 8,000. It's just about the ratio. So, Section 4, we figured out if we're dealing with a merger or a purchase, and we've calculated the price tag, the PC. Now we get to see how the actual accounting entries play out under those two very different paths. This slide is absolutely crucial for your balance sheet. Under the pooling of interest method, which you use for a merger, you literally pool everything together. You absorb all of the old company's reserves, general reserve, P&L account, all of it, into your own books. But with the purchase method, it's like the old company's financial identity is wiped clean. You do not record its general reserve or P&L. They're just gone. The only exception, and this is a big one to remember, is for statutory reserves. So, what happens with these statutory reserves in a purchase situation? Well, sometimes the law says the new company has to keep them going for a few more years. But since we can't bring in the profit that originally created that reserve, we need to do a special, kind of weird adjustment to get it onto our books. This is a common point of confusion for sure. And this is the journal entry for it. You credit the statutory reserve account to create it on your books. But what in the world do you debit? Well, you debit this totally made-up account called the Amalgamation Adjustment Reserve. It doesn't represent any real asset. It's just a balancing plug that the accounting standard requires. It'll show up as a weird negative item under reserves and surplus in your balance sheet until the legal requirement is over, and then you just reverse the entry. Okay, Section 5. Time to switch hats. We are no longer the buyer. We are now the accountant for the selling company, the one being taken over. Our entire job is to close down the books for good. The first two steps are pure mechanics. Step 1, open up a temporary account called a realization account. You're going to debit this account with all the assets that are being transferred. And here's the key. You do it at their book value. Why? Because you're trying to clear them off your books at the value they're currently sitting at. Step 2, you credit the realization account with all the liabilities that are being taken over. Again, at book value. Now, your assets and liabilities are gone, and the realization account is ready to show you the profit or loss on this whole deal. Moving on to Step 3, you record the purchase consideration that you calculated earlier. You debit the purchasing company's account, making them a debtor to you, and you credit your realization account. This is basically recording the sales price of your business. Then, Step 4, when you actually get the payment, whether it's cash or shares in the new company, you debit those new assets and credit the purchasing company's account to settle the debt. Simple as that. And now for the final cleanup. First, you pay off any liabilities that the buyer didn't want to take over. Next, you settle up with your preference shareholders. And finally, you gather everything that belongs to the owners, the equity shareholders. That means their original capital, all the reserves you've built up over the years, and the profit or loss you just calculated in the realization account. You dump it all into one big equity shareholders account. The balance in that account is then paid out to them using the cash and shares you got from the buyer. Once that's done, every single account is at zero, and the company's books are officially closed. And at last, Section 6. Let's put our purchaser's hat back on one last time. We've bought the business. Now, how the heck do we record it in our own books? This right here is the big one, the incorporation entry in the purchaser's books. It's actually pretty logical. First, you debit all the assets you're getting, but at their new agreed values. Then, you credit all the liabilities you're taking on, also at their agreed values. And finally, you credit an account called business purchase for the total PC you agreed to pay. Now, your debits and credits have to match, right? If the debit side, the assets, is less than the credit side, it means you paid more than the net assets were worth. That difference is a debit to an intangible asset called goodwill. If you got lucky and paid less, the difference is a credit to capital reserve. It's just the balancing figure.
I want you to picture this. You're in the exam hall. You've just spent, 40 minutes on that big amalgamation question? You've done the realization account, the journal entries, the whole shebang. You draw up that final balance sheet, and it doesn't tally. Oh, the panic just floods in. You know that feeling, don't you? So you're frantically scanning your calculations, but that clock is just ticking away, louder and louder. Where did the marks go? It probably wasn't in the big, obvious calculations. Nope, it was in the fine print, the little twists that ICAI loves to hide. Today, we find those marks. Okay, first up, we're diving into illustration 6 from the material. Now, on the surface, it looks like a classic absorption scenario, but trust me, it's packed with traps. We're focusing on unrealized profit and those pesky mutual owings. So here's the deal. Best LTD is taking over Better LTD. Now, the very first thing you have to notice is the sequence of events. Better LTD issues bonus shares before the takeover even happens. And right there at the bottom, you see the two classic traps waiting for you: an intercompany debt and unrealized profit hiding in the stock.
So first things first, let's nail down the purchase consideration, or PC. Now, you can't just grab the original share capital. Nope, you have to deal with that bonus issue first. Better Limited had 1 lakh shares, they did a 1-for-2 bonus, so now they have 1.5 lakh shares. The problem says these shares are worth 100 rupees each after the bonus. So a little multiplication and boom, the PC is 15 lakh. What ICAI is really testing here is simple. Can you follow the correct order of events?
Okay, let's look at the journal entries in Best LTD's books, the buyer. Check this out. When they take over the business, the net assets are actually 18 lakhs, but the PC is only 15 lakhs. That difference? It goes straight to the credit of capital reserve. And then, when they pay that PC, the shares are issued at a premium, so you see a credit to securities premium. After that, it's cleanup. Pass an entry to cancel that mutual debt, and another to get rid of the unrealized profit. Okay, let's really break down this unrealized profit thing because this is so important. Best LTD sold goods to Better LTD. When the amalgamation happens, some of those goods are still sitting in Better stock. Now they're one company, right? You can't make a profit by selling something to yourself. It has to be eliminated. This is a huge area where marks are lost. The profit was 25% on cost, which, as you know, translates to 20% on the sale price. You absolutely must use the sale price of that leftover stock, the 50,000, to calculate the 10,000 rupee profit that you need to knock out.
All right, let's level up. Moving on to illustration 7. This one makes things a bit tougher, focusing on a much more complex purchase consideration calculation where you have to wrestle with provisions before you can even get started.
Let's break this down into 4 simple steps. Step 1, you calculate the initial net assets. But, and here comes the ICAI twist, in step 2, you have to create provisions on inventory and trade receivables first. This brings the asset value down. Now, for step 3, that new adjusted net asset value, that is your final purchase consideration. And only then, in step 4, can you figure out how to split that PC between shares and cash. And there's another little adjustment in this problem you got to watch out for, the debenture swap. The 5% debentures of the selling company K Limited are being paid off, but look closely, at a 5% discount. It's a small detail, super easy to miss, but it will absolutely affect your final numbers.
And hey, just like the last problem, we've got another intercompany debt to deal with. It's a simple fix, right? A quick debit to trade payables and a credit to trade receivables in the new company's books, and it's gone. But I'm telling you, if you forget this, your balance sheet is guaranteed not to tally.
Okay, let's hit pause on the practical problems for a second and talk about some really critical theory. We need to understand the difference between an amalgamation in the nature of a merger versus one in the nature of a purchase, because this one distinction changes literally everything about the accounting entries you pass.
Now, this slide is gold. Seriously, it gives you the entire theory in one spot. Think of this as your checklist in the exam hall. In a merger, you're using the pooling of interests method. Assets and liabilities are at book value, and you carry forward the seller's reserves. Any difference between PC and net assets, you just adjust it against general reserve. But in a purchase, it's different. You can use fair values, reserves except for statutory ones get wiped out, and that difference in PC creates either goodwill or a capital reserve. All right, so here's where it gets really tricky. Statutory reserves. These are reserves that, by law, you have to keep on the books for a certain time. In a merger, it's easy. They just transfer over. But in a purchase, well, you still have to transfer them. You credit the statutory reserve to keep it alive, but what do you debit? This is the key. You have to create a fictional asset called the Amalgamation Adjustment Account. I'm telling you, this is an ICAI favorite. It's designed to test if you really understand the concepts, and so many marks are lost right here.
Okay, back to the numbers with illustration 9. And this one's a beast.
It's a multi-step monster where important stuff happens before the takeover and during it. This one is all about testing your grasp of sequence and really complex settlements.
Okay, the timeline is everything in this question. This is ICAI testing you, can you follow the sequence? You absolutely must account for the asset revaluation and the dividend payment before you even think about the amalgamation entries. Why? Because these pre-amalgamation steps change the numbers on the balance sheet that you're about to take over.
And this is just a beautiful example of a complex settlement. This is a guaranteed four-mark adjustment, I promise you. First, the debenture holders of Q Limited, the seller, get paid off at an 8% premium. That amount, $1,62,000, is then settled by P Limited, the buyer who issues new debentures at a 10% discount. You have to do the math to figure out that P Limited needs to issue debentures with a face value of $1,80,000. It's a two-step calculation, and people lose marks on it all the time.
And if that wasn't enough, this problem also throws in liquidation expenses paid by the buyer and new provisions on both debtors and inventory. You have to remember each of these is a separate, distinct adjustment. It really helps to have a mental checklist as you go.
All right, let's keep moving. Our next problem, illustration 10, is a pretty classic absorption scenario, but with a twist. The purchase consideration isn't just handed to you. You have to calculate it yourself, and you have to do it based on the fair value of the net assets.
So here's the deal. The purchase consideration is simply the total value of the net assets being taken over. But, and this is the key, you have to use the fair values from the problem, not the book values. You can see how goodwill, buildings, and machinery are valued up, but inventory is valued down, and there's a new provision for receivables. Just add up all these new fair values, subtract the liabilities, and that gives you your PC of $5,30,000.
And now we've reached the final boss, illustration 11. This is the ultimate twist, where ICAI slams two massive topics into one question. Before any amalgamation can happen, the acquiring company first has to perform an internal reconstruction. This is as tough as it gets, so you have to pay really close attention to the sequence of events. This is just a brilliant example of how ICAI layers concepts on top of each other, and the sequence here is absolutely non-negotiable. You have to pass all the internal reconstruction entries for B Limited, the buyer, first. The bank waiving the loan, the capital reduction scheme, all of that creates a credit in the capital reduction account, which B Limited then uses to write off its old losses. Only after B Limited has cleaned up its own house can it go out and acquire A Limited. If you get this order wrong, the entire problem falls apart.
Wow. Okay, we have covered a lot of ground. We've tackled unrealized profits, complex settlements, layered concepts, the whole thing. So before we wrap up, let's just consolidate everything into one final checklist. This is the list you're going to mentally run through before you finalize that balance sheet in the exam.
Here it is, your 7-point sanity check. Did you handle the unrealized profit on that intercompany stock? Did you eliminate all the mutual owings? Did you calculate goodwill or capital reserve correctly? Did you remember the special treatment for statutory reserves, especially that amalgamation adjustment account? Did you get through that complex debenture settlement? Did you do the pre-amalgamation adjustments first? And finally, did you follow the correct sequence of events when they combined topics? Just running through this list could be the difference maker.
Okay, before we even start, let me throw a challenge at you. Just think for a second. In all the balance sheets you've ever prepared, can you name the one and only one reserve that can actually show up with a negative balance? I'm not kidding. This is a favorite little trap that ICAI loves to set. Any ideas? You're looking at it right there, the Amalgamation Adjustment Reserve. Now, if that name sounds a little fuzzy or you've never even heard of it, you need to lock in, because this one tiny concept is where students lose marks attempt after attempt. And by the time we're done here, you'll know exactly what it is and why it's so important. And sometimes ICAI will really push your calculation skills. In a problem like this, the PC isn't just a simple number. You might have to issue shares based on each company's average profits, so the more profitable company gets more shares. And you might issue debentures not just as a lump sum, but to ensure a specific rate of return on the capital employed by each company. This is definitely an advanced level problem that tests multiple concepts at once. Think of this as your final checklist of all the common traps ICAI loves to set for students in the exam hall. Let's go through these fast. First, intercompany owings. If one company's books show a receivable from the other, they must be canceled out. Easy marks. Second, unrealized profit. Now listen, this is a massive ICAI trap. Seriously, star this. If the seller sold goods to the buyer at a profit, and those goods are still sitting in the buyer's inventory, that profit hasn't really been earned by the combined company yet. You have to remove it. Third, liquidation expenses. If the buyer pays them, it's basically part of the acquisition cost. So you debit goodwill in a purchase or adjust reserves in a merger. And finally, statutory reserves. And this brings us right back to our very first question. So here's the big reveal. Remember, in a purchase, you don't carry over normal reserves. But what if the old company had a statutory reserve, like an export profit reserve, that the law says you must keep on your books for 5 more years? Well, you have to show it. So to make the journal entry balance, you create a completely fictional asset called the amalgamation adjustment account. And the other side of that entry, the credit, that's our amalgamation adjustment reserve, and it shows up as a negative figure under reserves and surplus. It's an accounting trick to follow the law, and it's a beautifully clever concept for the exam. So, to wrap it all up in a nutshell, amalgamation is the big umbrella term. Your first job always is to check the 5 conditions to see if it's a merger or a purchase. That one decision tells you your accounting method: pooling for mergers, purchase for purchases. Always remember, PC is the price paid only to shareholders. And the final result, whether you adjust the difference against reserves in a merger or create goodwill or capital reserve in a purchase, is the direct outcome of that very first critical decision you made.
So let's end right where we started. I want you to burn this into your brain. When you're sitting in that exam hall and you turn the page to that big 16-mark amalgamation question, before your pen even touches the paper, before you do a single calculation, what is the absolute first question you're going to ask yourself? Because the answer to that question is the key that unlocks the entire problem. Get that right and you're already halfway to a perfect score. All the best.